Yeah, this is day 14. We'll be covering 2.3 equity securities today. So let's begin. Equity securities, yeah. Common stock is ownership shares. Common stocks, also known as equity securities or equities, represent ownership shares in a corporation. Each share of common stock entitles its owner to one vote on any matters of corporate governance that are put to a vote at the corporation's annual meeting and to share in the financial benefits of the ownership. The corporation is controlled by a board of directors elected by the shareholders. The board, which meets only a few times each year, selects managers who actually run the corporation on a day-to-day basis. Managers have the authority to make most business decisions without the board's specific approval. The board's mandate is to oversee the management to ensure that it acts in the best interests of the shareholders. The members of the board are elected at the annual meeting. Shareholders who do not attend the annual meeting can vote by proxy, empowering another party to vote in their name. Management usually solicits the proxies of shareholders and normally gets a vast majority of these proxy votes. Thus, management usually has considerable discretion to run the firm as it sees fit. Without daily oversight from equity holders who actually own the firm. We noted that in Chapter 1, such separation of ownership and control can give rise to agency problems. Among these are compensation schemes that link the success of the manager to that of the firm, oversight by the board of directors as well as outsiders such as security analysts, creditors, or large institutional investors, the threat of proxy contest in which unhappy shareholders attempt to replace the current management team, or the threat of a takeover by another firm. The common stock of most large corporations can be bought or sold freely on one or more stock exchanges. A corporation whose stock is not publicly traded is said to be private. In most privately held corporations, the owners of the firm also take an active role in its management. Therefore, takeovers are generally not an issue. Characteristics of common stock. The two most important characteristics of common stock as an investment are its residual claim and limited liability features. Residual claim means that stockholders are last in line of all those who have a claim on the assets and income of corporation. In a liquidation of the firm's assets, the shareholders have a claim to what is left after all other claimants such as tax authorities, employees, suppliers, bondholders, and other creditors have been paid. For a firm not in liquidation, shareholders have claim to part of the operating income left over after interest and taxes have been paid. Management can pay this residual as cash dividends to shareholders or reinvest it in the business to increase the value of the shares. Limited liability means that most shareholders can lose in the event of failure and corporation of the corporation is their original investment. Unlike owners of unincorporated businesses whose creditors can lay claim to the personal assets of the owner, house, car, furniture, corporate shareholders may at worst have worthless stock. They are not personally liable for the firm's obligations. Concept check 2.3. If you buy 100 shares of IBM stock, to what are you entitled? So I think if you buy 100 shares of IBM stock, you are entitled to 100 votes, 100 proxy votes, and also you are entitled to what else? You are entitled to the dividends that they pay, if they pay dividends on the 100 shares of the stock. And what else? You can make capital gain if the stock price increases by selling it and realizing the actual increase in stock price, share price value. What else? 100 shares actually not a lot of shares, obviously, so you won't have that much power when it comes to electing a board of directors and telling them what to do and how to run the company and how if and not to fire the management or whatever. but I think you still have like some sort of say. You can attend something, you can vote or something. So yeah, so like you're entitled to the dividends, I guess. So that's pretty much it. Part B is, what is the most money you can make on this investment over the next year? So the most money you can make out of equity common stock is infinite, since a share of IBM can increase to infinity, like theoretically, obviously not realistically, but theoretically it can increase to infinity. Like for example, not infinity in this case, but like for example, GameStop's stock in COVID times in 2020 or whatever, 2021, it increased, I don't know, like 1000%, 600%, but like a lot basically, and like exponential increase. And so that is a case of where the upside on a common stock is infinite and the downside is limited, because you can only lose what the share is worth. You're not personally liable, as it said, for any of your they won't basically come and take your personal assets. You can't be personally liable. So the most you can lose is only the value of the share. You can't go into negative. Anyways, so that's part B. Part C is, if you pay $150 per share, what is the most money you could lose over the year? So if you pay $150 per share, so that's 150 times 100, which is equal to $15,000. So let's say you bought $15,000 worth of IBM stock. Like that's a lot of money, right? So the most you could lose is actually $15,000, because you are not liable for anything. So since you are not liable for anything, they can't come and take, if like IBM goes bankrupt or whatever, right? They can't claim your personal assets. Your $15,000 will become zero. So therefore, the most you can lose is $15,000. So next up is this table right here, figure 2.8. So this is stock market listing of stocks traded on the New York Stock Exchange, NYSE, compared from data in the Wall Street Journal 2016. So as we can see, we have all these names of corporations and their symbols and their share price at close, their net change, their volume, 52-week high, 52-week low, so like yearly high and yearly low. Dividends, if they are paying dividends, and if they're not paying dividends, nothing. The yield, the price to earnings ratio, and this is year to date or something, percentage change, I don't know. So maybe that. So we have Gap, GPS, Gartner, IT, GATX, GMT, GATC Globe. So anyways, all these things. Some, like we have General Electric, GE. So it's 229.87 close. So all these numbers are here. So let's read about stock market listings now. So figure 2.8 presents key trading data for a small sample of stocks traded on the NYSE. The NYSE is one of several markets in which investors may buy or sell shares of stock. We will examine these markets in detail in chapter 3. So to interpret figure 2.8, consider the highlighted listing for General Electric. The table provides the ticker symbol GE. The closing price of the stock, $29.87, and its change minus $0.25 from the previous trading day. About 26.5 million shares of GE traded on this day. The listing also provides the highest and lowest price at which GE has traded in the last 52 weeks. Okay. One second. Okay. Yeah, the listing also provides highest one price. Okay, fine. The 0.92 value in the dividend column means that the last quarterly dividend payment was $0.23 per share. Last quarterly dividend payment was $0.23 per share. Okay, why is that? Sick. 4. Okay, so 0.92 divided by 4 is 0.23. That's what it means. So 1 second. 0.23 dollars per share, which is consistent with annual dividend payments of 0.23 times 4, $0.92 per share. This corresponds to an annual dividend yield, that is, annual dividend per dollar paid for the stock, of 0.92 by 29.87, which is equal to 0.0308 or 3.08%. So dividend yield is equal to annual dividend divided by dollar paid for one stock. So annual dividend you get from one share divided by the price of that one share is the dividend yield, which is given here, right here, this one. So next up is the dividend yield is only part of the return on a stock investment. It ignores the prospective capital gains, that is price increases or losses. Low dividend firms presumably offer greater prospects for capital gains, or investors would not be willing to hold these stocks in their portfolios. If you scan figure 2.8, you will see that dividend yields vary widely across companies. The PE ratio, or price to earnings ratio, is a ratio of the current stock price to the last year's earnings per share. The PE ratio tells us how much stock purchasers must pay per dollar of earnings that the firm generates. For GE, General Electric, the ratio of price to earnings is 30.68. The PE ratio also varies widely across firms, where the dividend yield and PE ratio are not reported in figure 2.8. The firms have zero dividends or zero or negative earnings. We shall have much to say about the PE ratios in chapter 18. Finally, we see that GE stock price has decreased by 4.11% since the beginning of the year. So that's that. That is a stock market listings. Now, preferred stock. So this is the other type of stock. So first one was like common stock, and then this is preferred stock. They're different. So preferred stock has a feature similar to both equity and debt. Like a bond, it promises to pay its holder a fixed amount of income each year. In this sense, preferred stock is similar to an infinite maturity bond, that is a perpetuity. It also resembles a bond in that it does not convey voting power regarding the management of the firm. Preferred stock is an equity investment. However, the firm retains discretion to maintain the dividend payments to the preferred stockholders. It has no contractual obligation to pay those dividends. Instead, preferred dividends are usually cumulative. That is, unpaid dividends accumulate and must be paid in full before any dividends may be paid to holders of common stock. So, in contrast, the firm does have a contractual obligation to make the interest payments on the debt. Failure to make these payments sets off corporate bankruptcy proceedings. Preferred stock also differs from bonds in terms of its tax treatment for the firm. Because preferred stock payments are treated as dividends rather than interest, they are not tax deductible expenses for the firm. This disadvantage is somewhat offset by the fact that corporations may exclude 70% of dividends received from the domestic corporations in the computation of their taxable income. Preferred stocks therefore make a desirable fixed income investments for some corporations. Even though preferred stocks ranks after bonds in terms of priority of its claims to the assets of the firm in the event of corporate bankruptcy, it often sells at lower yields than corporate bonds. Presumably, this reflects the value of the 70% dividend exclusion. Because the higher risk of preferred stock would tend to result in higher yields than those offered by bonds. Individual investors who cannot use the tax exclusion generally will find preferred stock yields unattractive relative to those on other available assets. So let's just read that again 1 second. Even though preferred stock ranks after bonds in terms of priority of its claims to the assets of the firm in the event of corporate bankruptcy, it often sells at lower yields than corporate bonds. Presumably, this reflects the value of the 70% dividend exclusion. Okay, 1 second. tend to result in higher yields in the bond. Individual investors who cannot use a tax exclusion generally will find preferred stock yields unattractive relative to those on the available assets. Preferred stock, I don't understand this part. Wait, 1 second. Preferred stock also differs from bonds in terms of its tax treatment for the firm. Because preferred stock payments are treated as dividends rather than interest. Okay. They are not tax deductible expenses for the firm. This disadvantage is somehow offset by the fact that corporations may exclude 70% of dividends received from domestic corporations in the computation of the taxable incomes. Preferred stock therefore make desirable fixed income investments for some corporations. Okay. So what I'm understanding is maybe preferred stock is not taxable that much. I don't know. Even though preferred stock ranks after bonds in terms of priority of its claims to the assets of the firm in the event of bankruptcy, it often sells at lower yields than corporate bonds. Presumably, this reflects the value of the 70% dividend exclusion, because the higher risk of preferred stock would tend to result in higher yields than those offered by bonds. Individual investors who cannot use the tax exclusion generally will find preferred stock yields unattractive relative to those on other available assets. Preferred stock is issued in variations similar to those of corporate bonds. It may be callable by the issuing firm, in which case it is said to be redeemable. It also may be convertible into common stock at some specified conversion ratio. Adjustable rate preferred stock is another variation that, like adjustable rate bonds, ties the dividend to current market interest rates. Depository receipts. American Depository Receipts, or ADRs, are certificates traded in the US markets that represent ownership in shares of a foreign companies, not country. Each ADR, American Depository Receipt, may correspond to the ownership of a fraction of a foreign share. One share or several shares of a foreign corporation. The ADRs were created to make it easier for foreign firms to satisfy US security registration requirements. They are most common way for US investors to invest in and trade the shares of foreign corporations. So we're down 2.3 equity securities. That was quite a lot to digest, but that was good. Now we're gonna do 2.4. We got a lot of time today because my exam's over, so I can finally do this properly and freely. So yeah, 2.4 is stock and bond market indexes. Stock market indexes. The daily performance of the Dow Jones Industrial Average is a staple portion of the evening news report. Although the Dow is the best known measure of the performance of the stock market, it is the only one of several indicators. Other more broadly based indexes are computed and published daily. In addition, several indexes of bond market performance are widely available. The ever increasing role of international trade and investments has made indexes of foreign financial markets part of the general news as well. Thus, foreign stock exchange indexes such as Nikkei Average of Tokyo and the Financial Times Index of London are fast becoming household names. Dow Jones Industrial Average. So, the Dow Jones Industrial Average, DJIA, of 30 large blue chip corporations has been computed since 1896. Its long history probably accounts for its preeminence in the public mind. The average covered only 20 stocks until 1928. Originally, the DJIA was calculated. The DJIA, my bad, was calculated as the average price of the stocks included in the index. Thus, one would add up the prices of 30 stocks in the index and divide by 30. The percentage change in the DJIA would then be the percentage change in the average price of the 30 shares. This procedure means that the percentage change in the DJIA measures the return, excluding dividends, on a portfolio that invests one share in each of the 30 stocks in the index. The value of such a portfolio, holding one share of each stock in the index, is the sum of 30 prices. Because the percentage change in the average of the 30 prices is the same as the percentage change in the sum of the 30 prices, the index and the portfolio have the same percentage change each day. Because the Dow corresponds to a portfolio that holds one share of each component stock, the investment in each company in that portfolio is proportional to the company's share price. Therefore, the Dow is called a price weighted average. Example 2.2, price weighted average. Consider the data in table 2.3 for a hypothetical two-stock version of the Dow Jones average. Let's compare the changes in value of the portfolio holding one share of each firm and the price weighted index. Stock ABC starts at $25 a share, increases to 30. Stock XYZ starts at 100 but falls to $90. Portfolio initial value 25 plus 100 is equal to $125. Final value 30 plus 90 equals to $120. Percentage change in portfolio value equals to minus 5 by original value 125 equals to minus 4%. Initial index value 25 plus 100 by 2, 62.5. Final index value 30 plus 90 by 2, 60. Percentage change equals to minus 2.5 by 62.5, which is equal to minus 4%. So as you can see, these both are the same, right? So the portfolio and the index have the identical 4% declines in value. Note that the price weighted averages give higher priced shares more weight in determining performance of the index. For example, although ABC increased by 20%, while XYZ fell by only 10%, the index dropped in value. This is because the 20% increase in ABC represented a smaller price gain, $5 per share, than the 10% decrease in XYZ, $10 per share. The Dow portfolio has 4 times as much invested in XYZ as in ABC because XYZ's price is 4 times that of ABC. Therefore, XYZ dominates the average. We conclude that a high price stock can dominate a price weighted average. Therefore, higher price stock dominates the price weighted. Okay, so table 2.3 is this one. So just exactly what we did right now. So yeah, you might wonder why the DJIA is now in late 2016 at a level of about 19,000. If it is supposed to be the average price of 30 stocks in the index, the DJIA no longer equals the average price of 30 stocks because the average procedure is adjusted whenever stock splits or pays a stock dividend of more than 10%, or where one company in the group of 30 industrial firms is replaced by another. When these events occur, the divisor used to compute the average price is adjusted so as to leave the index unaffected by the event. In the same way, the other divisor is updated for stock splits. If one firm is dropped from the average and another firm with a different price is added, the divisor has to be updated to leave the average unchanged by the substitution. By 2016, the divisor for the Dow Jones Industrial Average had fallen to a value of about 0.146. Because the Dow Jones averages are based on small numbers of firms, care must be taken to ensure that they are representative of the broad market. As a result, the composition of the average is changed every so often to reflect changes in the economy. Table 2.5 presents the composition of the Dow Jones Industrials in 1928. Example 2.3, splits and price weighted averages. Suppose XYZ were to split 2 for 1 such that its share price fell to $50. We would not want the average to fall, as that would incorrectly indicate a fall in its general level of market prices. Following a split, the divisor must be reduced to a value that leaves the average unaffected. Table 2.4 illustrates this point. The initial share price of XYZ, which was $100 in table 2.3, falls to $50. Stock splits at the beginning of the period. Notice that the number of shares outstanding doubles, leaving the market value of the total shares unaffected. We find the new divisor as follows. the index value before the stock split was equal to 125 by 2 equal to 62.5. We must now find a new divisor D that leaves the index unchanged. 1 second. Yeah, okay. So 125 by 2. Yeah, okay. We just want to find a new divisor D that leaves the index unchanged after XYZ splits and its price falls to $50. Therefore, we solve for D in the following equation. Price of ABC plus price of XYZ divided by D equals to 25 plus 50 by D equals to 62.5. So D equals to 75 by 62.5, which is equal to 1.2. So which implies that the divisor must fall from its original value of 2.0 to a new value of 1.2. Because the split changes the price of the stock XYZ, it also changes the relative weights of the two stocks in the price weighted average. Therefore, the return of the index is affected by the split. At the period end, ABC will sell for $30 while XYZ will sell for $45. Representing the same negative 10% return, it was assumed to earn in table 2.3. The new value of the price weighted average is 30 plus 45 by 1.20 equals to 62.5, the same as its value start of the year. Therefore, the return rate is 0 rather than the minus 4% that we calculate in the absence of a split. The split reduces the relative weight of XYZ because its initial price is lower. Because XYZ is poorer performing stock, the performance of the average is higher. The example illustrates that implicit weighting scheme of the price weighted average is somewhat arbitrary, being determined by the prices rather than by the outstanding market values, price per share times number of shares of the shares in the average. Table 2.4 is this. Okay, so we just talked about that. Okay, so what are we reading about this sentence here? Yeah, table 2.5 presents the composition of the Dow Industrials 1928 as well as its composition as of mid 2016. The table presents striking evidence of the changes in the US economy in the last 85 years. That's crazy. Many of the bluest of the blue chip companies in 1928 no longer exist. And the industries that were the backbone of the economy in 1928 have given way to some that could not have been imagined at the time. Concept check 2.4. Suppose the price of XYZ in table 2.3 increases to $110 while ABC falls to $20. Find the percentage change in price weighted average of the two stocks. Compare that to percentage return of a portfolio holding one share in each company. So let's say that price of XYZ increased to $110. So initial index was what? It was $25 plus $100 by 2, right? Which was 62.5. This was the initial index. And then now we have new one is 20 plus 110 by 2, which is equal to what? 130 by 2. 130 by 2, which is equal to 65. So now we can do basically 65 minus 62.5 by 62.5. So this is 2.5 by 62.5, which is equal to 4%. So this is a 4% increase, I think. Yeah, this is a 4% increase. Find the percentage change in the price weighted average of the two stocks. So 4% percentage change is in the price weighted average, and then compare the percentage return of a portfolio holding one share in each company. So yeah, that was 4% only. Find the percentage change in price weighted average. Percentage change portfolio, percentage change in index. Okay, I guess it'll be the same. So it'll be basically 130 minus 125 by 125. So that's 5 by 125. Okay, that's definitely not 4%. Oh no, it is 4%. What the hell am I saying? It is 4% actually. So this is the first one. This is the second. They're the same. So yeah. the same. Yeah. Table 2.5 companies included in the Dow Jones Industrial Average 1928 and 2016, so like 85-year difference. So as we can see in 1928, we had Wright brothers, so like Wright Aeronautical, like they were the first to fly a plane and everything, right? Allied Chemical, North American, Victor Talking Machine. That's very funny. Victor Talking Machine's funny. International Nickel, International Harvester, Westinghouse, Texas Gulf Sulfur, General Electric. That's crazy. General Electric is still there, I think. Actually, it's not. It's not there now. Oh no! Wait, hold up. Oh, it's still there. Okay, General Electric is still there. That's actually crazy. That's insane. It's probably the only one. Maybe. Anyways, American Tobacco, Texas Corp, Standard Oil, Sears Roebuck, General Motors is still there probably, Chrysler, Atlantic Refining, Paramount Publics, Bethlehem Steel, General Railway Signal, Mack Trucks, Union Carbide. Oh yeah, Union Carbide's Bhopal gas leak. That was tragic. American Smelting, American Can, Postum Inc., Nash Motors, American Sugar, Goodrich, Radioco, Woolworth, and US Steel. US Steel is actually crazy. But yeah, 3M, American Express, Apple, Boeing, Caterpillar, Chevron, Cisco Systems, Coca-Cola, DuPont, ExxonMobil, General Electric, Goldman Sachs, Home Depot, Intel, IBM, Johnson & Johnson, JP Morgan Chase, McDonald's, Merck, Microsoft, Nike, Pfizer, Procter & Gamble, Travelers, United Health Group, United Technologies, Verizon, Visa, Walmart, and Walt Disney. So those are the current Dow Jones companies. Actually, this is like 10 years ago, so I don't know what they are now. So yeah. Ticker symbols, industries. So industries, we have diversified industrials, consumer finance, electronic equipment, aerospace and defense, construction, oil and gas, construction, beverages, chemicals, oil and gas, diversified industrials, investment banking, home improvement retailers, semiconductors, computer services, pharmaceuticals, banking, restaurants, pharmaceuticals, software, apparel, pharmaceuticals, household products, insurance, health insurance, aerospace, telecommunications, electronic payments, retailers, broadcasting and entertainment. Years added to the index. So, yeah. Yeah, in this, like, Apple was the most recent addition as far as I can see. Yeah, Apple was the most recent addition in 2015, it said, I think. Yeah, 2015. Yeah, okay. So now comes the Standard & Poor's 500 index, S&P 500, which is known as. So yeah, let's start. The Standard & Poor's Composite 500, S&P 500 stock index represents an improvement over the Dow Jones averages in two ways. First, it is a more broadly based index of 500 firms. Second, it is a market value weighted index. In the case of the firms XYZ and ABC, in example 2.2, the S&P 500 would give ABC 5 times the weight given to XYZ because the market value of its outstanding equity is 5 times larger. $500 million versus $100 million. The S&P 500 is computed by calculating the total market value of the 500 firms in the index and the total market value of those firms on the previous day of trading. Okay, so it's a market value weighted index. Okay, the S&P Yeah. The S&P is computed by calculating the total market value of the 500 firms in the index and the total market value of those firms on the previous day of trading. The percentage increase in the total market value from one day to the next represents the increase in the index. The rate of return of the index equals to the rate from one day. The rate of return on the index equals to the rate of return that would be earned by an investor holding a portfolio of all 500 firms in the index in proportion to their market values, except that the index does not reflect cash dividends paid by the firms. Example 2.4, value weighted indexes. To illustrate how value weighted indexes are computed, look again at table 2.3. The final value of all outstanding stock in our two stock universe is 690 million. The initial value was table 2.3, which one's that? This one. Okay, so initial value of outstanding stock, okay, 690 million. Fair enough. The initial value is 600 million. Therefore, if the initial level of a market value weighted index of stocks ABC and XYZ was set equal to an arbitrarily chosen starting value, such as $100, the index value at year end would be 100 times 690 by 600 equals to 115. 1 second. Okay. This increase in the index reflects a 15% return earned on a portfolio consisting of the two stocks held in proportion to the outstanding market values. Unlike the price weighted index, the value weighted index gives more weight to ABC, whereas the price weighted index fell because it was dominated by higher price XYZ. The value weighted index gives rises because it gives more weight to ABC, the stock with higher total market value. Note also from table 2.3 and 2.4 that the market value weighted indexes are unaffected by stock splits. The total market value of outstanding XYZ stock decreases from $100 million to $90 million regardless of the stock split, thereby by rendering the split irrelevant to the performance of the index. Okay. Unlike the price weighted index, the value weighted index gives more weight to ABC, whereas the price weighted index fell because it was dominated by higher priced XYZ. The value weighted index rises because it gives more weight to ABC, stock with a higher total market value. Note from table 2.3 and 2.4 that the market value weighted indexes are unaffected by stock splits. The total market value of outstanding XYZ stock decreases from $100 million to $90 million regardless of the stock split, thereby rendering the split irrelevant to the performance of the index. Concept check 2.5. Reconsider companies XYZ and ABC from concept check 2.4. Calculate the percentage change in the market value weighted index. Compare that to the rate of return of the portfolio that holds $500 of ABC stock for every $100 of XYZ stock. So let me see again. 2.4. Rate of return portfolio holds $500 of ABC stock, $100 of 2.4. Oh, okay. So basically we have to consider the number of shares now. So 2.3, so shares of ABC is 20, shares of 20 million, shares of XYZ is 1 million. So basically what we do is we do 20 million times 1 second. 20 times. Yeah, okay. So it was originally 25, so 20 million into $25 per share plus 1 million into, it was what, $100 per share. So this was the original. This was 20 into 25, that is equal to 500 plus 600. And then the new one was 20 into 20 into 20, because in concept check 2.4 ABC falls to $20, so 20 into 20 plus 1 into 110 is equal to 400, so like 510. So basically your rate of return on the portfolio that holds $500 of ABC stock for every $100 of XYZ stock. Acha. 1 second. Okay. What's that? 90 by 600. 15% drop. So $500 of ABC stock. $500 of ABC stock. Okay. That's 20 shares. I gotta check the answer for this one. It's a little bit confusing. It's concept check 5, I think. Pretty sure. Yeah, 2.5. So the market value weighted index returns calculated by computing the increase in the value of stock portfolio. Stock portfolio 2 stock starts with an initial value of 100 million plus 500 million, 600 million. Fund value is 210 million. Plus 510 million. So we did that. So that's 90 by 600, 0.5. Yeah, we got 0.5. We got 0.5 right here. That only. Or did I do 0.5? Okay, it's basically it's like this, right? So 510 we got here, 600 we got here. So therefore the percentage change is equal to negative 15%. Okay, you got that. Index portfolio return is a weighted average of returns stock with weights of 1 by 6 on XYZ and 5 by 6 on ABC, weights proportional to investments. Because the return on XYZ is 10%, while the on ABC is minus 20%, the index portfolio return is okay. Okay, so I guess I got it. Like, I mean, to be fair, what? Acha, okay. So, okay. So, okay, one second. Okay, so one second. Okay, so he's holding $500 of ABC share stock, $100 of XYZ. So that's like what, 5 to 1, right? So 5 to 1. So basically, what he's doing is that he's owning $500 of ABC. So that's like 5 by 6 of ABC, and ABC's return he's getting minus 20% because the stock is falling. stock is falling from 25 to 20. So that's a 5 by 25. 5 by, wait, one second. Yeah, 5 by 25. Am I tripping? So 1 by 5. Yeah, 5 by 25 is 20%. So 20% negative. He's getting a return from ABC, and from XYZ he's getting a return of 10% because it's going from 100 to 110. Okay, so that's like 10 plus 1 by 6 times 10%. So the total thing is coming as negative 15%. So that is the percentage change in the market value weighted index, which is equal to minus 15%. Done. Finally done. Yeah, a little bit confusing, but we got through it. Yeah, let's continue. Has it been 45 minutes? Yeah, so I'll stop there. I'll might make another video right now, or might not, depends on. Actually, I won't, because I have to eat some food. So we'll stop right there for today. It was a good session, and tomorrow we'll continue with where we left off, and then look at other indexes, and then 2.5 is derivative markets. So we'll probably start that as well. And actually, you know what? I'll eat some food first, and then like at 10. Yeah, at 10 I'll make another short video. Or I'll see. If I'm in the mood, then I'll make another one. But if not, I'll leave it at this. And yeah, that's it. Yeah, thanks.